Have you ever looked at a company's financial report, seen these really impressive profits, and thought, wow, they must be absolutely rolling in cash, only to maybe find out later they're actually, struggling to pay their bills?
It happens more often than you'd think.
It's like seeing someone with a super fancy car, but then realizing they can't actually afford the gas for it. That feeling of disconnect, the information overload, it's definitely real.
Absolutely.
And that's really why we're taking this deep dive today. We're focusing on one of the most crucial, but honestly, often misunderstood financial statements.
Yeah.
The statement of cash flows.
Yeah, it's fundamental.
Our mission here, really, is to arm you with the ability, the superpower almost, to quickly spot a company's actual cash movements. Forget just the profit number for a second.
Right.
We want you to understand the real cash coming in, the cash going out, where it's coming from, where it's going, and also the different ways companies show you this stuff.
And what's really insightful, I think, is that the cash flow statement can sometimes reveal a company's sort of dirty little secret. High profits on paper, but absolutely no cash in the bank.
Exactly.
Think back to the dot-com bust, maybe. Lots of companies looked amazing based on revenue, but they were completely cash poor. It led to their downfall. This statement, it's like your early warning system. It shows you who's actually holding the gold, not just, claiming they have it.
That's a great way to put it, an early warning system. And to boil it right down, at its absolute core, a statement of cash flows is about two main things, isn't it? Mm-hmm. Cash coming in, those are receipts, positive numbers usually, and cash going out, payments, the negative numbers. It's just tracking that flow.
Exactly that. And the main technique, the sort of fundamental way we often figure out these cash flows, is by calculating them as a balancing figure.
Okay, a balancing figure.
Yeah, imagine you know where an account started, like cash or maybe taxes payable, and you know where it ended up.
Right. Opening and closing balance.
Precisely. And you also know about things that affected that account without involving cash, maybe an accounting adjustment or a non-cash expense.
Okay.
The difference, the amount you need to make everything balance out from that adjusted starting point to the end point, that difference has to be the cash flow. It's like finding the missing piece of the puzzle.
Ah, I see. So it's like you're reverse engineering the cash part from everything else you know. That makes sense.
Exactly.
Okay, well, to really see this balancing act in action, let's maybe play detective a bit with some typical company scenarios.
Good idea.
Let's peek into the books of a fictional company, say Crombie Co., and see if we can uncover how their cash really moved. Maybe start with something pretty fundamental, like income taxes.
Perfect starting point. It's an operating activity.
Okay. So imagine Crombie Co. On January 1st, their books show $500 in income taxes payable, liability. Mm-hmm. By December 31st, end of the year, that figure is $900. Mm-hmm. And somewhere else on their profit or loss statement, he shows a tax charge for the year of $1,000.
Right, the expense recognized.
So the question is, how much cash do they actually pay out in taxes during that year?
Okay, let's solve this using that balancing figure idea. We reconcile the income taxes payable account. You start with the opening balance, the $500 they owed at the start.
Okay.
The $1,000 tax charge, that's an expense that increases how much tax they owe, right? So you add that $1,000 to the opening liability.
Right. So $500 plus $1,000, that's $1,500 they would owe if they hadn't paid anything.
Exactly. But we know the closing balance, what they actually owed at year end, is only $900.
Ah, so the difference.
The difference. To get from $1,500 down to $900, they must have paid out $600 in cash. That $600 is the balancing figure, and it represents the cash that flowed out to pay taxes. It's a classic operating cash outflow.
Okay, that really clarifies it. It's a very direct application of that balancing principle. Simple logic once you see the steps. Mm-hmm. Now, let's try one that's maybe a little more complex. Payments to buy property, plant, and equipment. PPE, this usually falls under investing activities, right?
That's right. Acquisition of long-term assets.
Okay, Crombie Co. again. Let's say they started the year with PPE having a carrying amount of $100,000. That's the value on their books, after depreciation and stuff.
Got it. Book value.
By the end of the year, the carrying amount was down to $30,000. Now, during the year, a few things happened that weren't cash purchases. They recorded $2,000 in depreciation.
Okay. Non-cash expense reduces book value.
They also had a $6,000 revaluation surplus. So the book value of some asset went up, but no cash actually came in or out, just an accounting entry of paper gain.
Right, affects the carrying amount, but not cash directly for purchases.
And they sold some old PPE. Its carrying amount, its book value, was $1,500, but they sold it for $2,000 cash.
Okay, disposal.
So the big question, Based on all that, what was the actual cash paid for any new PPE they bought during the year?
Right. This is a great example. Again, we use the balancing figure for the PPE account. Start with the opening carrying amount, $100,000.
Okay.
Now, adjust for all the non-cash changes to that carrying amount. Depreciation reduced it, so subtract the $2,000.
$98,000.
The revaluation surplus increased the book value, so add the $6,000.
Okay, back up to $104,000.
And they disposed of PPE that had a carrying amount of $1,500. That $1,500 value is now off the book, so we subtract that carrying amount.
Right, so $104,000 minus $1,500 is $102,500.
Right.
That's what the book value should be based on everything except new purchases.
Precisely. But we know the actual closing balance is only $30,000.
Big difference.
To get from our calculated $102,500 down to the actual $30,000 closing balance, the company must have spent cash on new PPE. The balancing figure is, let's see, $102,500 minus $30,000. Oh, wait, I think I added one I should have subtracted somewhere. Let's retrace. Opening $100,000, less depreciation, $2,000 and $6,000, $104,000. Less carrying amount of disposal, $1,500, $102,500. Okay, that's the subtotal before considering purchases. The ending balance is $30,000. That implies a disposal, not a purchase. Let me rethink the logic here.
Or maybe I gave you the wrong closing balance. Let's say the closing balance was higher.
Right.
Say $130,000 instead of $30,000. Let's redo it with $130,000 as the closing PPE balance.
Okay, that makes more sense for illustrating a purchase. So, opening $100,000, less $2,000 depreciation equals $98,000, plus $6,000 revaluation equals $104,000, less $1,500 carrying amount disposed equals $102,500. That's the balance before purchases.
Right.
If the final closing balance is $130,000, then to get from $102,500 up to $130,000, they must have purchased new PTE. The difference, the balancing figure, is $130,000 minus $102,500, which is $27,500.
Okay, so $27,500 cash paid for new PPE.
Yeah.
That's shown separately. It's a positive cash inflow, also under investing activities. Sale of PPE.
Okay, so the purchase outflow and the sale inflow are separate lines in the investing section.
Exactly. And this brings up a really common point of confusion. You mentioned the sale price was $2,000, but the carrying amount was $1,500.
Right, so there's a $500 profit on that sale. Correct. Now, why does that $500 profit on disposal affect the operating activities section, while the $2,000 cash from the disposal affects the investing activities section?
Yeah, that's a fantastic question.
Yeah.
It seems a bit counterintuitive at first glance, doesn't it? Is it just down to like one being an accounting adjustment for profit calculation and the other being the actual cash changing hands for an asset?
Precisely. You nailed it. The $2,000 cash received, that's literally cash coming in from selling a long-term asset, an investment, so investing activity inflow.
Makes sense.
But the $500 profit on disposal, that's an accounting gain. It got included when calculating the company's overall profit for the year, but it's not cash generated from their day-to-day operations.
Ah, okay.
So if we're using the indirect method for operating cash flow, which starts with profit, we have to adjust that profit figure. We need to take out items that aren't related to core operations, like this gain on selling an asset. So we'd actually subtract that $500 gain when calculating cash from operations.
Okay, so you subtract the gain in operating, but you show the full cash proceeds in investing. It's about making sure each section reflects the right type of cash flow.
Exactly right. Separating the accounting impact from the actual cash movement and classifying it correctly.
That distinction is absolutely critical.
Okay.
That clears up the PPE quite a bit. Let's move to our final example for the calculation part. Dividends paid. This is usually a financing activity. Yeah.
Yes, returns to providers of capital. Financing.
Okay, Crombie Co. again. Let's look at their retained earnings. Started the year at $5,000. During the year, they made a profit of $4,500, and their retained earnings at the end of the year were $7,000. So how much cash did they pay out as dividends?
All right, same logic. Reconcile the retained earnings account. Start with the $5,000 opening balance.
Okay.
Profit for the year increases retained earnings, right? So add the $4,500 profit.
$5,000 plus $4,500 is $9,500.
Yeah.
That's what retained earnings would be if no dividends were paid.
Perfect. But we know the actual closing balance is $7,000, lower. So to get from $9,500 down to $7,000, the difference must be what was paid out as dividends. $9,500 minus $7,000 is $2,500.
So $2,500 paid in dividends.
That's the cash outflow, classified under financing activities. It shows how much cash the company returned to its owners. It's not just a number. It tells you something about their policy. Are they rewarding shareholders? Do they see reinvestment opportunities? And so on.
Right. So we've kind of pulled apart these individual cash movements using this balancing idea. But, I mean, imagine trying to make sense of just a long, long list of every single cash in and cash out. It would be total chaos.
Utter chaos. You wouldn't see the patterns.
Which is why, presumably, accounting standards like IAS 7 group them together. They give us structure, right?
Yeah.
Into those three crucial buckets, the three pillars, if you like.
That's spot on. To make it understandable, IAS 7, that's the International Accounting Standard governing cash flow statements, requires cash flows to be classified into three main categories. First up, operating activities. These are basically the cash flows from the main day-to-day business. The principal revenue-producing activities, so things like cash coming in from customers, cash paid out to suppliers and employees, and as we saw, income taxes paid, your core business cash flow.
Got it. Core operations.
Second, investing activities. This is all about the acquisition and disposal of long-term assets and other investments. Think buying or selling property, plant, and equipment. Or maybe buying shares in another company, or receiving dividends or interest because you own investments. It's about how the company's investing for the future, or cashing out old investments.
Right. Long-term assets and investments.
And finally, financing activities. These are the cash flows that change the size and makeup of the company's equity and its borrowings. So cash coming in from taking out new loans or issuing new shares to investors, and cash going out to repay debt or buy back shares or, as we just calculated, paying dividends to shareholders, how the company funds itself.
Operating, investing, financing. Okay, that structure makes sense. But then, within those operating activities you mentioned earlier, there's actually a choice in how companies present that information. Two different ways.
Indeed. This is where it gets quite interesting. IAS 7 allows two methods just for presenting the cash flows from operating activities: the direct method and the indirect method.
Okay, direct and indirect. How do they differ?
Well, the direct method is, I think, quite intuitive. It basically shows the major types of actual gross cash receipts and gross cash payments from operations. It's like looking directly at the main operating cash flows.
So you'd literally see...
You'd see lines like cash receipts from customers, then cash paid to suppliers, cash paid to employees. You sum those up, maybe deduct income taxes paid, and get your net operating cash flow. It shows you exactly where the operating cash came from and when.
Okay, let's use an example. Say a company using the direct method shows cash receipts from customers were $800,000, and maybe cash paid to suppliers and employees combined was $626,000.
Right.
So that would give $800,000 minus $626,000. That's $174,000 in cash generated from operations before taxes. Then if they also showed, say, $13,000 paid for income taxes, you'd subtract that. $174,000 minus $13,000 gives a net cash from operating activities of $161,000.
Exactly. Very transparent about the actual cash movements, isn't it? You see the big flows.
It seems very clear, yeah. So why have another method? What's the indirect method?
Well, the indirect method is actually more common in practice, even though some argue it's less intuitive. Instead of listing the direct cash flows, it starts with the company's profit before tax from the income statement.
Okay, starts with profit.
Yes. And then it adjusts that profit figure for a few key things to get back to the actual cash flow from operations. First, it adjusts for any non-cash items that were included in the profit calculation.
Like the depreciation we talked about.
Exactly. Depreciation and amortization, they reduce the reported profit, but no cash actually left the company. So using the indirect method, you add back depreciation and amortization to the profit figure.
Okay, add back non-cash expenses. What else?
You also adjust for non-cash income, or items that aren't truly operating, like that profit on the sale of PPE we discussed. It increased profit, but it wasn't an operating cash inflow, so you deduct that gain from profit.
Right, take out non-operating gains.
Then the big adjustment area is for changes in working capital. Things like inventories, trade receivables, money owed by customers, and trade payables, money owed to suppliers.
How do those adjustments work?
Think about the cash impact. If your inventory level increases during the year, you've tied up cash buying that extra inventory.
Right.
So an increase in inventory is a deduction from profit when calculating cash flow.
Okay, more inventory, less cash available. Subtract.
Same logic for trade receivables. If customers owe you more at the end of the year than the start, receivables increased, that's cash you haven't collected yet. So an increase in receivables is also a deduction.
Right. Haven't got the cash yet.
Yeah.
Subtract.
But if inventory or receivables decrease, that means you've sold inventory or collected cash. That frees up cash. So a decrease in inventory or receivables is an addition back to profit.
Got it. Decrease, cash freed up. Add.
And for trade payables, it's the reverse logic. If you owe your suppliers more at the end of the year, payables increased, you've effectively held onto cash longer. So an increase in payables is an addition to cash flow.
Okay, delaying payment keeps cash. Add.
And if payables decrease, you've paid your suppliers faster, using up cash. So a decrease in payables is a deduction.
Makes sense. Add back non-cash expenses, deduct non-cash gains, adjust for working capital changes. Then what?
After all those adjustments to profit, you arrive at cash generated from operations before income tax. And then, just like the direct method, the final step is to deduct the actual income taxes paid in cash during the period.
Okay, let's try applying that indirect method to our $161,000 example.
Yeah.
We need a starting profit figure. Let's say the operating profit before tax was $80,000.
Okay, start with $80,000 profit.
Let's say depreciation was $50,000 and amortization was $40,000. Those are non-cash expenses.
So you add both back, $80,000 plus $50,000 plus $40,000 and $170,000.
That working capital, say inventories increased by $5,000, 30K end versus 25K start.
Increase in inventory uses cash. Deduct $5,000. So $170,000, $5,000, $165,000.
Trade receivables decreased by $6,000, 20K end versus 26K start.
Decrease in receivables frees up cash. Add $6,000. So $165,000 plus $6,000, $171,000.
And trade payables increased by $3,000, 14K end versus 11K start.
Increase in payables keeps cash. Add $3,000. So $171,000 plus $3,000, $174,000.
Okay, so that gets us to $174,000 cash from operations before income taxes, which is the same figure we got using the direct method example.
Exactly, $174,000. And then the final step is the same. Deduct the income taxes actually paid, which we said was $13,000.
So $174,000 minus $13,000 gives $161,000.
$161,000 net cash from operating activities. What's really fascinating here, and the key takeaway, is that it doesn't matter which method you use, direct or indirect, the final number, the net cash from operating activities must be the same, $161,000 in our example.
So they're just two different ways of arriving at the same destination. One shows the direct flows, the other reconciles from profit.
Precisely. The indirect method has the advantage of clearly linking profit to cash flow, showing how non-cash items and working capital bridge the gap. The direct method gives perhaps a clearer picture of actual cash receipts and payments. Both are valid under IAS 7.
That's a really powerful insight. It makes you realize profit isn't the whole story.
Yeah.
I remember looking at a company's income statement once years ago, seeing these huge profits and thinking, wow, they must be absolutely loaded. But then I looked deeper at their cash flow statement using the indirect method and saw they were building up massive amounts of inventory. All that profit was just sitting there as unsold goods, tying up cash. That was my first real lesson in why cash is, well, often king.
It truly is. Profit is an opinion, cash is fact, as they sometimes say.
So wrapping this up, what does this all mean for you listening in? Hopefully you can see that understanding the statement of cash flows, its different classifications, those calculation methods, especially the balancing figure idea, and provides a really vital lens into a company's actual, tangible financial health.
Yeah, it goes way beyond just the profit number.
This deep dive, we hope, has shown you how to decode those cash inflows and outflows, understand operating, investing, financing, and see the purpose behind the direct and indirect presentations. So maybe a final thought to leave you with. Now that you can see where a company's cash really comes from and goes, maybe consider how this changes your perspective when you next see a company reporting a big profit. Are those profits always a true reflection of immediate financial strength? Or is it the cash flow statement that holds the deeper truth? Is cash truly king?